Here's a summary of General Motors' 2025 Q3 earnings call transcript, focusing on key financial metrics, management forecasts, risks, highlights, and important statements from the CEO and CFO. General Motors 2025 Q3 earnings call summary introduction. Welcome to the General Motors Q3 2025 earnings conference call, held on Tuesday, October 21, 2025. Joining us are Barra, GM's Chair and CEO, and Paul Jacobson, GM's Executive Vice President and CFO. CEO Barra's opening remarks. Barra began by acknowledging the GM team's dedication and hard work in navigating a dynamic regulatory and policy environment while prioritizing customers. She highlighted a strong third quarter for earnings and free cash flow, with the U.S. achieving its highest Q3 market share since 2017 and a profitable restructured China business. Key financial highlights and forecasts. Revenue and profit. While specific revenue figures weren't explicitly stated for Q3, the call emphasized strong earnings and free cash flow. The company is raising its full-year 2025 guidance. Full-year 2025 guidance raised. EBIT adjusted, $12 billion to $13 billion. EPS diluted adjusted, $9.75 to $10.50 per share. Adjusted automotive free cash flow, $10 billion to $11 billion. Gross margin, not explicitly detailed for Q3, but Barra mentioned achieving strong margins in the U.S. Paul Jacobson noted that Q3 U.S. EBIT adjusted margins were 6.2%, which would have been around 9% excluding tariffs, aligning with their 8% to 10% target. Future quarters/years. 2026 outlook. GM expects 2026 to be even better than 2025, driven by EV loss reduction, warranty cost improvements, tariff offsets, regulatory compliance, and fixed cost management. EV profitability. The company aims to reduce EV losses in 2026 and beyond by addressing overcapacity and improving profitability through new battery chemistries and architectural enhancements. ICE strategy. ICE volumes are expected to remain strong for longer, with GM well positioned to meet sustained demand. Software and services. Robust double-digit revenue growth is anticipated through the end of the decade, with gross margins of approximately 70% from services like OnStar and Super Cruise. Significant risk factors. Chip supply from China, an industry-wide issue that has the potential to impact production, though teams are working to minimize disruptions. Evolving regulatory framework and EV adoption. Near-term EV adoption is lower than planned due to regulatory changes and the end of federal consumer incentives. This leads to higher variable costs due to underutilized EV capacity. Tariffs. The transcript heavily discusses tariff impacts and mitigation strategies. While progress is being made, tariffs remain a significant cost factor. Supply chain resilience. GM is actively working to build resilience in areas like aluminum, semis, and rare earth materials, with ongoing discussions and sourcing assessments. Consumer and credit market concerns. While GM sees consumer resilience, they are monitoring potential impacts if employment were to weaken. Key highlights. Strong U.S. market share. Achieved highest Q3 market share since 2017. Profitable China business. Restructured China operations were profitable again, with market share growing and equity income rising for 4 consecutive quarters. Onshoring production. Significant capital investments to onshore production in Tennessee, Kansas, and Michigan. Doubling planned Chevrolet Equinox production at Fairfax Assembly. New engine production. Investing nearly $1 billion to build a new generation of advanced fuel-efficient V8 engines in New York. EV sales growth. Pre-incentive phase-out reached record EV sales in Q3 due to a pull forward in demand before consumer incentives ended, solidifying the 2 position in the U.S. EV market. Software and services growth. nearly $2 billion in revenue from OnStar, Super Cruise, and other software services year-to-date. Deferred revenue up 14% to nearly $5 billion, with OnStar subscribers up 34% year-over-year. Super Cruise customers nearly doubled year-over-year. Autonomous vehicle strategy. Developing next-generation software-defined vehicle platforms, aiming for smarter, more capable, and personalized vehicles with reduced complexity and new revenue streams. Capital allocation. Strong execution on capital allocation, including significant debt paydown and share repurchases. Diluted share count down 15% year-over-year. GM financial performance. Solid quarter with $800 million in EBT adjusted. Key lowlights and mitigating actions special item charge, $1.6 billion in Q3, $1.2 billion for non-cash impairments related to Orion assembly transition, battery module capacity reductions, hydrogen fuel cell development halt, and CAFE credits, $0.4 billion for cash charges related to supplier contract cancellation. Brightdrop production halt. Stopping Brightdrop production at CAMI assembly due to slower than expected commercial electric van market development and challenging regulatory/incentive changes. This will result in an additional charge in Q4. Warranty expense headwind. A $900 million year-over-year increase in warranty expense in Q3, which GM acknowledges as too high, and is addressing with a multi-pronged approach involving dealers, suppliers, data/AI, and proactive updates. Cash outlays has stabilized. Softening EV demand. Acknowledging a significant softening in EV demand in October, expected to continue into early 2026. GM will build to demand and focus on EV profitability. CEO Mary Barra's most important statements. Based on our performance, I'm pleased to share that we are raising our full-year guidance. As trade policies have evolved, we have acted with urgency and discipline to strengthen GM's position. Now, with an evolving regulatory framework and the end of the federal consumer incentives, it's clear that near-term EV adoption will be much lower than planned. This is resulting in higher variable costs. All of this drove our decision to transition Orion assembly from EV to ICE production and to sell our joint venture-owned cell plant in Michigan to LG Energy Solution. It's also why we recorded a $1.6 billion special item charge in the third quarter. EVs remain our North Star, so we will continue to invest in new battery chemistries like LMR, new form factors, and other architectural improvements to drive improved profitability. I'm equally confident in our ICE strategy. It is clear that ICE volumes will remain higher for longer. Our top priority as a leadership team remains returning North America to our historical 8% to 10% EBIT margins. So far this year, we have recognized nearly $2 billion in revenue from OnStar, Super Cruise, and other software services, and our deferred revenue was up 14% from Q2 to almost $5 billion. Our next-generation software-defined vehicle platform will be transformational because we will be able to evolve the software layer of each vehicle independently from the hardware-defined physical layer. Regarding Adam Jonas's departure, I am extremely proud of our team's strategy and our ability to adapt to various changes, which is clearly resulting in successful execution. While we haven't always seen eye to eye, I valued our discussions. I wish you the best in your future endeavors. Regarding Chinese OEMs in the U.S. market, we require a level playing field, and I have been quite vocal about that. With fair competition, we intend to win over customers with superior vehicles, as we are currently doing. Regarding autonomous vehicles, our focus is on personal autonomy and Level 4. We are not involved in rideshare services at this time, and when considering the complexities of operating a robotaxi fleet, that is not currently our core business. We are concentrating on individual vehicles. Closing, our immediate priorities are clear. We are committed to restoring North America to our historical margin levels and accelerating the expansion of our software and services business on top of great vehicles. CFO Paul Jacobson's most important statements. We continue to demonstrate disciplined incentives, pricing and inventory management while attaining a 17% U.S. share in the quarter, up 50 basis points year-over-year. Our U.S. incentives remain below the industry average for the 10th consecutive quarter. Total company EBIT adjusted was $3.4 billion, down $700 million year-over-year. This included a gross tariff impact of $1.1 billion. Adjusted automotive free cash flow was $4.2 billion, partially aided by $300 million in cash tariff offset reimbursements. North America delivered Q3 EBIT adjusted margins of 6.2%, enabled by record crossover deliveries and strong performance of our full-size pickups and SUVs. As in the second quarter, EBIT adjusted margins in Q3 would have been around 9%, excluding tariffs, well within our prior margin target of 8% to 10%. EV sales reached record levels in Q3, supported by a pull forward in demand ahead of the consumer purchase incentive being eliminated. GM solidified its position in the U.S. EV market with 67,000 deliveries and a 16.5% share. Warranty expense was a $900 million headwind year-over-year in the third quarter. This is too high, and we need to do better. GM China is continuing its successful turnaround and is comparing favorably to many of its global peers. Based on strong product traction, ongoing disciplined execution, and assuming minimal production disruption from the chip issue Mary mentioned earlier, we are raising our calendar year 2025 guidance. We expect capital expenditures to be at the lower end of our $10 billion to $11 billion guidance range as we recalibrate our plan in light of policy and upcoming footprint changes. Looking ahead to 2026, we have multiple levers to carry our current momentum forward. As a result, we expect next year to be even better than 2025. In closing, GM is stronger and more resilient than ever. We are adjusting our business to a new tariff and regulatory environment. Responding to tariff questions, the President's announcement on Friday did a number of things beyond just the heavy-duty tariff. It included the lengthening of the MSRP offset to 3.75%. It also included the ability to designate parts into 232 that expands the pool of eligible parts. Regarding capital allocation, we invested $2.1 billion in capital projects, paid down $1.3 billion of balance sheet debt, and repurchased $1.5 billion of stock in the quarter. This summary captures the essential financial and strategic updates from GM's 2025 Q3 earnings call.